All assets are crashing. What's going on? Gold, the dollar, and Bitcoin are down, even US stocks. Oil prices are falling, but how is this possible? Since oil drives all costs, shouldn't everything be cheaper? Production costs should go down, or maybe shipping costs should drop. Shouldn't other prices rise? Or is this something else? Are we entering a recession? So is there a recession happening right now? Yes, there are some spots where it's happening, but it's still not the big picture yet. The truth is, unless every asset is somehow tied together and their values all drop at the same time, which is pretty unlikely, right? If, in reality, all asset values stay the same, but the reason everything seems to drop across the board is actually because the measuring stick itself has gotten bigger. So what exactly is this measuring stick? In this video, we're going to explain what the asset price measuring stick really is, and who controls this measuring stick. And in the not-so-distant future, will this measuring stick get bigger, making all assets look smaller? Or will it get smaller, making all these assets look bigger? Will prices inflate? By the way, you can support this video about assets dropping across the board because of the US dollar alone on the Sand Money Monster channel by scanning this QR code. Go ahead and scan it. Or you can support the Sand Money Monster channel. Like, share, and comment. If you haven't subscribed yet, don't forget to hit subscribe for us too. And if anyone wants to support Sand Money Monster so we can keep making fun and independent content like this for a long time, you can become a member. Thank you so much. Which assets have dropped across the board? Let's take a look at this chart first. We'll only talk about some of the cool commodities here. I'll also go back and show you the picture from this past May. For example, crude oil has already dropped by 30%. Gold's dropped 10%, silver's down 20%, aluminum and steel are down 10%, and Bitcoin in a month has plunged 20%. As for the US stock market, looking at the S&P 500, it's been moving sideways lately. It seems like it's still deciding which direction to go. You might ask why? Why did everything drop together like that? It's like they all agreed, hey, are we all gonna lose value at the same time now or what? That doesn't really make sense. Or if you want to say, well, the war isn't over yet. The MOU, the US is supposed to sign a ceasefire with Iran, Israel is attacking Lebanon, the MOU isn't finalized, Hormuz says it will open, Iran says keep it closed. If you ask how interested viewers are in war news right now, to be honest, I'm sick of war news. The people writing about it are bored. Won't viewers get bored? With news the MOU failed and Iran saying they won't open the Strait of Hormuz, interest is fading. Fine, it's staying closed. Let's check the market. If we look at the Brent crude oil price chart, we can see that oil prices have only gone up a little compared to back in March when the Iran war first started. Oh, back then, Brent crude oil prices shot up to over $100 per barrel. But now, even though the number of ships leaving Hormuz has dropped to almost zero, oil prices are still around $76 per barrel. This shows that if you ask the market is surprised, but not as much as when the war first started. So this point where oil prices have dropped this deep right here. Honestly, shouldn't this be an opportunity for other assets? Because when oil prices go down, that means production costs and transportation costs decrease, which means inflation should also go down. That should increase the profitability of listed companies. So shouldn't stocks go up as well? Strangely, oil prices have dropped a lot, but stocks, especially the hyperscalers like Microsoft, Nvidia, Meta, etc., when oil goes down, hyperscaler stocks go down too. Look at this chart. If you compare them, you'll see that since the end of June up until now, oil prices have dropped a lot, right? And hyperscaler stocks have also dropped a lot. They've dropped deeply on the same scale too. A lot of people see this and say, hey, could this mean a recession? If everything is dropping this much. Oil prices are down, everything is down, costs fell, but stocks haven't risen. That means a recession, because when the world enters a downturn, the economy will contract. Once the economy contracts, the amount of money circulating in the economy will decrease. This leads to a drop in demand for goods and services. And when demand goes down, it causes the production of goods and services to decrease as well. And when production decreases, the demand for raw materials and transportation will also decrease and contract. And when people need to produce less, the need for transportation drops as well, which means the demand for oil goes down and contracts. So if the demand for oil decreases, the drop in oil prices we're seeing might not have anything to do with whether the Strait of Hormuz is open or closed. It might just be that the economy's contracting, so the demand for oil is going down, which is why oil prices are falling. So does that mean stocks aren't going up? Or maybe there's another hypothesis, like, no, it's not because the economy is contracting that much, because if you ask, sure, the economy isn't great these days, but is it really shrinking that severely? There's no pandemic, and the war is pretty much contained, so things are just kind of staying where they are. Everyone is still eating and spending as usual. It's not shrinking that much, but the reason why all asset prices are dropping at the same time, could it be because the measuring scale has gotten bigger? So that's why assets seem smaller. So the prices look lower. Take a look at this. Editor, please get the division ready. Let's set up each of these different assets as an icon. These specific icons are going to include gold, silver, oil, steel, aluminum, Bitcoin, and United States stocks. After you have finished doing that, go ahead and draw a dividing line, because every single one of these different assets will be divided by a specific unit of measurement called the US dollar. If the US dollar starts to become significantly stronger, this ruler will get longer, bigger. The assets above stay exactly the same in value, but they look smaller. And on the days when the dollar weakens, this ruler gets shorter. The assets are still in the same place, but they look bigger. Do you see what I mean? All these assets I mentioned, whether it's oil, gold, silver, iron, Bitcoin, or US stocks, are all valued in US dollars, right? And when it comes to trading or exchanging these commodities, 90% of the time, it's done in dollars, US dollars. So if the US dollar gets stronger, the prices of these things will look lower. But if the US dollar gets weaker, the prices of these commodities will look higher, you get it? So it might actually be true, just like how people feel when they watch the news right now. Like, at this moment, we're tired of war, whether the Strait of Hormuz is open or closed. If you want to track your finances, focus on whether the US dollar gets stronger or weaker. Watch the dollar index, the DXY. Let's look back from the start of 2026 up until now. The dollar index has strengthened DXY, it's near 96. Today is July 13th. In 2026, the DXY is around 101, so it's gone up about 5%. So let's see if our hypothesis holds, that if the dollar strengthens, commodities and other assets really weakened. Let's compare the graphs. The DXY is the white line, and commodities, or commodity assets, are represented by the blue line. And we can see the relationship more clearly. Every time the DXY or white line drops, commodities go up. And every time the DXY or the white line goes up, commodities or the blue line drop. And if you want to see the picture even more clearly, just flip the commodities chart upside down. Then you'll really see that at the very end there, when the dollar gets really strong, commodities basically drop straight down. And if you look back and see the bigger historical picture, you'll notice that 90% at times when commodity asset prices fall, it's not because of a recession, it's not because there's not enough supply, but it's because the benchmark or USD gets stronger. To explain what's happening with the S&P 500 right now, let's compare the DXY with the S&P 500. Let's make DXY white and S&P 500 orange, just like before. We'll see that whenever the DXY rises, the S&P 500 drops. This happened in 2015, 2020, and 2022. By early 2026, investors might feel incredibly wealthy as gold, silver, and US stocks hit record highs. This is because the DXY, the dollar, fell sharply. At this point, a lot of people are like, okay, Jai, I get it now. I understand that the US dollar, or DXY, is the measuring stick, the ruler for the price of all assets. Now that I know this, what can I actually do? Let me tell you, if it's this measuring system, we can't do anything about it. It's out of our hands. But what we can do is asset allocation, like how do we prepare? Where should we position ourselves? And then, how do we know what to look at? Which policies and assets should we focus on? And that helps us narrow down the scope. This helps us narrow things down in this market. So in the equation where all assets are priced in US dollars, so the one who can move markets, the only one controlling asset prices worldwide, is the person who controls the US dollar. And that person? Is it the US government that controls the dollar? Yes, but not entirely. The real person pulling the strings is actually the US Central Bank, the Federal Reserve, or the Fed, because the Fed has the authority to raise or adjust US interest rates up or down, right? And the Fed has the ability to raise or lower the yield rate as well. They can also adjust the yield on the US government's two-year bonds. If anyone thinks, oh, if the Fed is the one who controls the yields on government bonds, why do they only control the two-year bond? Because that's all they can control. For longer-term bonds, like 10 or 30-year notes, the Fed can't control those. They depend purely on market forces. Back to what the Fed controls. Look at this graph of the two-year yield on US government bonds compared to the dollar index. Remember 2022? What happened? The Fed raised interest rates. That means the Fed really stepped on the gas and raised interest rates. So the yield on two-year treasuries climbed and the DXY value rose. They both went up simultaneously. I remember it clearly. Interest rates shot up so fast. I watched Bitcoin drop from 60,000 to 40,000, all the way until the Fed raised rates. It hit the bottom at 17 or 15,000. Now compare that to the NASDAQ, where most hyperscalers are. Ever since 2026 began, the Fed hasn't lowered interest rates. Interest rates look set to rise. The NASDAQ AI isn't booming as expected. It's just moving sideways. But if we look at the big picture of the NASDAQ together with the US two-year Treasury yield historically, going back to around 2023, which was after the interest rate hikes were done, you'll see that the NASDAQ has been booming for a long stretch from 2023 all the way up to now. Because the yield on the US two-year Treasury bond has gone down throughout that entire period. So to emphasize again, it's all about the Fed, just the Fed. If the Fed raises interest rates, the dollar NDX, or the benchmark used to measure the price of all other global assets, will shrink, prices will drop. But if the Fed cuts rates, the dollar weakens. With a smaller benchmark, asset prices fall, rise on their own. The question is, following financial channels, you needn't be worried. Just follow financial channels. So what makes the Fed raise or lower interest rates? The answer is incredibly simple, just one word: inflation. The Fed's #1 main responsibility is to keep the country within its inflation target. And the inflation target for the United States is 2%, but right now it's at 4.2. So if inflation is high, what the Fed has to do is raise interest rates. But if inflation is low, what the Fed has to do is lower interest rates. So you might ask, well, where is the world at right now? The current global situation is that we're facing an energy crisis. Everyone's tired of hearing about war or the Strait of Hormuz closing, but it's actually the most important thing to know, because the amount of oil exported through the Strait of Hormuz to the world is 20%. From the day it closed, it's still at 20%. If Hormuz is not open, oil is a major factor in the cost. The world's transportation infrastructure is gone. What about oil reserves? How much is left in each country's reserves? How many more days? And if it's gone, how will people survive? Now, if we look at the near future, if the war doesn't end soon, inflation will rise. And if inflation goes up, that means the Fed will have to raise interest rates automatically. Interest rates. If the war continues, an energy crisis is inevitable. This would hike production and transport costs, driving up inflation and forcing the Fed to raise interest rates. A Fed rate hike boosts the dollar, or DXY, the asset price benchmark, is gonna increase. This means global asset values will shrink, driving prices down even further. So the question is, if the war continues, will all those assets we discussed crash like today? The answer is no, because they could fall even deeper than this.